Good afternoon. On behalf of the NC Chamber, welcome to Ask the Experts, the COVID-19 economy, slowdown or shutdown. I am Janelle Boyd with the NC Chamber. All attendees are muted to avoid any distractions during today's presentation. If time permits, we will answer as many questions as possible at the end of the presentation. If you would like to submit a question during the meeting, click to use the question and answer box. Please do not use the chat box. You may upvote the question you most want answered by clicking on the thumbs up for that question. The questions with the most votes will be answered first. The recording of today's webinar will be made available to you via email within 24 hours of the webinar. Now, I would like to introduce today's moderator, Dan Gerlach. Dan?
Thank you, Janelle, and welcome everybody to this call on COVID-19 economy, slowdown or shutdown. My name is Dan Gerlach. I'm a consultant to the North Carolina Chamber, and we've heard a lot about flattening the curve and all about the statistics on the healthcare side of on keeping us all as safe as well as possible here in North Carolina and all around the United States and around the world. Today, we're going to talk about the flip side of that coin, about what is happening with the curve of the damage that is already been felt by us all across the globe. And we have three different perspectives from three different leaders of our community of whom I have had the honor to meet, and I'm honored to MC this today. But first, we'll hear from Tom Barkin. He's the president and CEO of the Federal Reserve Bank of Richmond. That is the regional bank that oversees central bank operations in 5 states: Virginia, West Virginia, Maryland, North Carolina, and South Carolina, as well as the District of Columbia. He comes from a long and distinguished career with McKinsey Consulting, a major consulting firm that you've heard of. And so he brings a private business perspective. Tom has a keen interest, I know from my time at the Golden Leaf Foundation, in the rural, especially in the rural areas in his district, and that's how I met him. So we're glad to have Tom with us today. I want to introduce all the panelists, and then we'll go in order. Second is Dr. Michael Walden, a friend of mine from longstanding. He's the William Neal Reynolds Distinguished Professor at North Carolina State University. He gets bossed around by 2 deans, one in the the College of Agriculture and Life Sciences, and one in the Poole College of Management. He is a widely quoted, widely celebrated, and is one of the best academic economists at translating the economy into things that ordinary people can understand. It's a real skill set of his. He is very gracious with his time. He has won numerous awards for public service for teaching and his research. And certainly last and certainly not least is Mark Vittner. He's the managing director and senior economist with Wells Fargo Securities down in Charlotte. And since we're the voice at the North Carolina Chamber of Private Business, we wanted to have a private business leader there. He's been with the bank since 1993 through 2020, and met him through John Sylvia, a good friend of ours who was the former chief economist with Wells Fargo there in Charlotte. And Mark, I remember well, and had I don't know if it's the chance or the misfortune to be in New York City on 9/11 back in 2001. That's how long we've known each other. So the first point we're going to give each of the economists and business leaders about 10 minutes to talk. I want to give them a guided question, which them being economists and business leaders will ignore and talk about what they wanted to talk about anyway, but we'll start with Tom Barkin. So Tom, from the Fed's Bank, and you're a member of the Federal Open Market Committee, and you've certainly had more than you could say grace over. Tell us a little bit from your view about how what the economic impact has been, and what's the path that you see to get us going forward when this is all cleared up. And I remember from my Economics 101 days that the GMP, and we've seen a lot of GDP, that we've seen a lot of statistics and forecasts on from about every bank, every forecaster, and how bad it is, consists of consumption plus business investment plus government spending plus net exports. And the problem is that consumption is 70% of it. So there's only a limited amount, if you increase the government spending, we can do on the fiscal side to get us out. But you've been working on the monetary side, I know. So I'll leave it to you. Mr. Barkin, the floor is yours.
Thanks, Dan, and great to see you again, even if it's virtually. So what's been the impact of this on the economy? It's been staggering. As you know, it started with a shutdown of a large part of the personal service economy, whether that be physical retail or restaurants or travel or arts and entertainment. About 30 million people work in those sectors alone. Yesterday, we saw the March statistics for retail sales, and really this episode hit the last half, not the entire month. And even that half month impact alone was the biggest drop in retail sales in over 50 years. Just to give you some specific real-time numbers, hotels are down 84% year over year in revenue per room versus a year ago. Box office receipts are basically zero. TSA throughput, the people who go through security lines, down 96% versus a year ago. So this is having a staggering impact on that part of the business. And the rest of the economy hasn't escaped it. Automotive demand has plunged, which has shut down that critical manufacturing sector. The struggles of the airlines have affected aerospace. $25 oil is decimating the drilling and exploration sector. Retail closures are damaging landlords. And even hospitals are facing a revenue crunch as they forego their higher profit elective surgery in support of this health crisis. Cash flow and liquidity are challenges everywhere. And this has come on so fast that the data we get is basically obsolete. But one thing I do look at every week is initial unemployment claims. For the last couple of years, they've averaged around 200,000 a week, which is actually 50-year lows. The record before a month ago was 695,000 in 1982. Over the last 4 weeks, we've seen over 20 million, right? And that's 20 million Americans have filed for unemployment in the last 4 weeks, and more are still in the queue. And that alone, yeah.
Sorry, Tom, just to put it in perspective for people, that's out of a 22 million out of a total labor number of employed labor force of about 160 million. That's about 13% have filed for unemployment, let alone those who have not filed.
Yeah, so Dan obviously didn't just take economics in high school, in college. He's learned it since then too. And that's exactly right. And so it's not hard at all to imagine, mid-teens unemployment. Remember, the unemployment for April is really measured this week. And the net of all that, I'd just say in terms of how the economy is doing is you hear a lot of emotion from folks in these industries. They're suffering so that the health of the rest of us won't. And I think that's a real challenge for us. Now, given the profound implications of all this on the economy, you see work in three different lanes. And I should say the last crisis was a financial crisis. I very much thought, I wasn't there at the time, but I thought the Fed had the first chair in that crisis. In this crisis, public health has the first chair. I'd say fiscal has the second chair. And there's a lot the Fed and monetary policy can do, but I really do think we're in the third chair here. And let me just talk briefly about each of those. On the public health dimension, we are doing social distancing on a massive scale, as well as investing significantly in increasing hospital capacity. There's obviously still more to do, widespread testing, whatever tracking and tracing protocols we decide to pursue, and of course, vaccines or treatments. On the fiscal side, there's been an unprecedentedly sized package. I'll call it fiscal stabilization rather than stimulus, because I really think it's been built to bridge people from where they were before, and businesses, from where they were before to hopefully the other side. And so you see welcome increases in payments to low and moderate income individuals, unemployment insurance expansion, a small business loan program, the PPP, funding to some endangered industries like airlines and hospitals. I should say these are good concepts in this kind of situation, but the core challenge the fiscal side has here is delivering the money to the people who need it. And I'm sure we'll get some questions on the PPP and the small business program. I would just say I have some empathy. The Small Business Administration, I don't think, was designed to deliver $320 billion in a week or two. And even the individual cash, you saw the first payments go out this week. But just a reminder, roughly 50% went out this week. That's the 50% of people who file electronically. The other 50% don't file for their taxes with direct debit or direct deposit. And so the Treasury Department has to track down their routing numbers to send them money directly, or actually, wheel out a printing press and start printing checks. And like the SBA, they weren't built to write that many checks in 1 week. And so that'll take some number of weeks to get there too. So I think the fiscal money is significant and needed. And the challenge here is just getting it in the right pockets at the right time. On the monetary side, again, I'd say we're the third chair, but given our independence and frankly, given our experience in the last crisis, I think we were able to move the fastest. We had an unscheduled meeting and moved rates to zero. We've given strong guidance to banks that they should continue to be lending to good credits in need, recognizing that we need to do that while preserving safety and soundness of the banking system. We've made significant interventions to try to backstop markets that had gotten volatile, like the Treasury and the mortgage-backed markets, the commercial paper, the asset-backed markets, and money market funds. And then the legislation in the CARES Act put $434 billion to backstop new lending programs. Last week, we announced one for new and secondary market investment grade credits. We announced a lending facility which will take PPP paper effectively off bank balance sheets and free up their capacity to do more. And then we're working on, and we'll announce in the next couple of weeks, a short-term municipal tax anticipation facility and a Main Street lending program that would make 4-year loans with first-year payments deferred to medium-sized business. As Jay said last week, and I want to emphasize, these are lending programs, not spending programs. They're focused on supporting otherwise good credits through their time of need. So then, Dan, you asked, how do we best rise out of this? And I really do think the core challenge here is getting to the other side with a healthy population and a functioning economy. That will require the shortest possible duration of a shutdown that's consistent with good health. But importantly, we're not going to be able to wait all the way to where we get a zero infection rate. And so 4 keys that I see to arriving at a reasonable post-crisis velocity. The first is continued operation of essential industries. We do need our food manufactured, our packages delivered, fire and safety, cleaning supplies, cash processed, hospitals functioning, supply chains operating, electricity on, and broadband available. And there are many, many workers in those industries, and they need to stay healthy and, of course, motivated. The second is we need to return to operations. Now, this will likely be gradual. I don't think there's just a point and shoot version of it. But I do think the experience of China and the experience in our essential industries should give us confidence this is doable, as long as we adopt some proven protocols like appropriate structural distancing or cleaning procedures, temperature testing, gloves, masks, and the like. The third is a return to consumer confidence. And I think this is the hardest one because this has been a real shock. We will need consumers to spend again to get to the other side. And perhaps a treatment or a vaccine will appear. If so, I think it's pretty straightforward. But if not, businesses that require personal interaction are going to need to rethink their protocols. They're going to need a story that'll convince consumers it's okay to shop or to travel or to go to a restaurant again. I'm reminded of 9/11. You mentioned that earlier. It was a real mess when we rolled out the TSA over the 3 months after 9/11. Long lines, lots of controversy over don't fly lists and the like. But I think when you got to January of 2002, you could convince yourself that you were getting on a plane with an extra layer of safety that you didn't have before, and you weren't putting your family at risk if you did that. I'd say supermarkets are doing something similar today. You're met with somebody in a mask who wipes down your grocery cart. At least my grocery store has one-way aisles to make sure that you have social distancing. There's tape in the line so you don't stand too close to someone. There's a sneeze guard at the cashier. And I think you can walk into a grocery store and feel pretty confident that you're not putting your family at risk. And I think all businesses that have personal interaction are going to need to think about how do we communicate that, define it, and communicate it compellingly to our customers. I noted the airlines have started mentioning middle seats empty. I'll bet you restaurants will have more spacing. I'll bet there'll be more automation in certain retail areas. The fourth thing is we've just got to limit the damage. And of course, that's what a lot of this fiscal is intended to do. But we want to return to a growing economy on the backside of this. And a growing economy has a growing workforce and it has increasing productivity. Some of the stuff I just talked about, like half the number of tables in a restaurant, is a challenge to productivity, not the other way around. A lot of businesses may well end up with a lot more debt on the backside of it. You may have some startups go under. All that will be an inhibitor to productivity. And so we're going to have to make sure we're got incentives for the right kind of investment on the back end. The other part of growth is growing a labor force. And we've already seen in the numbers some lessening in labor force participation. Childcare is a challenge for many families. And I wouldn't be surprised if some two-career couples say, have they doubts in childcare going forward, and perhaps someone makes choices to leave the workforce. We may need to redeploy a lot of workers from, let's call it baristas, to home health workers. And if that's the case, we need to think hard about how do we streamline and make accessible the right kind of education and training program for those folks. So that's something I focus on as well. Just to sum up, I really am convinced this is a temporary, not a permanent situation. A lot is being done to try to bridge the gap. And I just fundamentally believe in American science and that in its ability to develop a treatment or a vaccine that will allow us to put this particular episode behind us. And when we do, there is a lot of fiscal and monetary stimulus that can kick in. But the key to me to get the full impact of all that stimulus is our ability to accelerate as we make the turn. And that's going to require a story across health practices and business practices for how the American consumer, which you rightly say is 70% of our economy, can do what he or she wants without putting their families at risk. Thanks, Dan.
Thank you very much. Next, I've changed my background to give a kind of more agriculture feel for our agriculture economist, Mike Walden, coming up here. Mike, I wanted to ask you for your perspective on that same question of what's the economic impact been, and how do we rise from this from the North Carolina perspective? I know tomorrow morning the March numbers for North Carolina will be released by the North Carolina Department of Commerce. Again, as Tom mentioned, not showing the full effect because the survey is taken in the middle of the month, but it will provide us some sense of the direction of who's the leading indicators of where the damage has been already here. So Michael, let's hear from you.
Thanks, Dan, and I don't know if Talisa's listening. I don't see my slides, Talisa. Oh, there we go. Oh, boy, just mention and I get it. And Talisa's going to advance them for me. I have a few slides, so go right to the next slide, please. Here's what I want to talk about very briefly with each topic. The economy before the virus, what I'm calling the mandated recession, how bad the federal rescue, when's the recovery, what kind of recovery, and long-run impacts. Next slide, please. I think one of the reasons why we're feeling so bad in the economy is we had a pretty good economy going into this. We had a record length of economic growth since the last recession. That is, we set a record for sustained economic growth, longest in our history, 10 years plus. We had a GDP growth rate of around 2%, which is many economists think is about normal given the fact we've got a slow growth in our labor force, rising real wages, low unemployment under 4%, and low inflation. When I took my first economics course about 50 years ago, they told us we couldn't have low unemployment, low inflation at the same time. So the fact that we had that was room for applause. Next slide, please. I call this the mandated recession because this is unlike any recession we've had. This is my 6th recession I've lived through as a professional economist. Most recessions are caused, well, we had a few recessions caused by problems in the oil market in the 70s. Most recessions are caused by excessive exuberance, which leads to people taking more risk, people and businesses acquiring too much debt. We clearly saw that with the Great Recession, primarily that all that stuff happened in the housing market. And when the housing prices stopped going up, we had a collapse. This recession was really a mandated recession. The government has said, in order to control this virus, in order to limit deaths, we're going to have to shut down a substantial part of the economy. So that's why this is totally unlike any other recession. And I keep telling people in my presentations, look, all the numbers we're going to hear this quarter, certainly this month and next month, are going to be really, really bad. We shouldn't be surprised. One of my quibble points with the media is every time we get a bad number out like today, the media makes a big deal about it, and I understand that, but we should not be surprised. When you can't have restaurants, when you can't have retail, when you can't have interaction, you're not going to have much of an economy. So we're clearly in a recession now. Now, we won't have an official recession called, and incidentally, that's called by no one in the government, but it's called by economic think tank, the National Bureau of Economic Research. But clearly, we're in a recession. Next slide, please. It's going to be, I think, very, very deep, but it's going to be short. For example, right now, some numbers I found, 52% of non-food retailers are now closed. I saw a report this morning that suggests that layoffs and furloughs and reduced hours are now spreading from the service sector into the tech sector, higher paid jobs. People are finding there's just not work there. Second quarter is going to be just horrific in terms of real GDP, probably down between 20 and 30% in that quarter. Jobless rate's going to clearly be in double digits. Incidentally, this is both nationally and North Carolina. Now, I think things will improve in the third quarter, improve in the sense it won't be as bad. We'll either get a small dip, maybe no change, maybe if we're lucky, a small increase, and then I don't think we're going to see substantial growth until the fourth quarter. But if you look at the magnitude of the numbers, especially in terms of what we're going to lose this quarter, it's going to take us a while to get back to the economy that we had before this virus. Next slide, please. I want to give a little bit of a context here because there have been a lot of comparisons made to the Spanish flu. 1917, 1918 killed 500,000 people in the US. Actually, it didn't start in Spain. There's a lot of evidence that actually started in the US. It was called Spanish flu because there were media blackouts among the World War I combatants. Spain was not a combatant, so when the virus popped up there, the media said, oh, we're going to call this the Spanish flu. Anyway, actually, a more relevant comparison is something I lived through. I was born in 1951, called the Asian flu of 1957-58, which killed 116,000 Americans. Now, interestingly, we didn't have mandated shutdowns there, although I will say I remember my father telling me a company he had went belly up during during that Asian flu. But we didn't have mandated shutdowns, but a lot of businesses closed simply because they didn't have workers. They had a lot of workers that were ill. We did have a recession that followed that. It was a recession that spanned 57, 58. In the worst quarter, though, real GDP was down about 10%. So hopefully we're not going to meet the 116,000 deaths. Looks like we may, if we're lucky, we may get 50, 60, maybe a high of 70,000. Got to remember the population was half what it is now in 1957. But I think this shows you the trade-off because we're going to have a much bigger drop in GDP, but we're going to have fewer deaths. And that's really the trade-off that we're going through now. How much economic cost do we want to bear in order to save lives and reduce the levels of illness? Next slide, please. Now, as Tom, I think, alluded to, and is certainly more qualified to speak to than I am, the federal government has stepped up big time. They stepped up very quickly as compared to the Great Recession when you go back and Monday morning quarterback and say, well, the government was late getting to the stimulus package. Federal Reserve was late in terms of what they did. But I think the main reason why our power, federal government power, in terms of both fiscal and monetary policy really stepped up fast is, again, we knew this was going to cause a recession. When you tell workers you can't go to work, you can't go out, you got to stay in your houses, that's going to cause a recession. And the help has been massive. Fiscal policy, the 2.2 rescue package we just had, and was probably going to be more. Monetary policy, lower interest rates, $4 trillion lending program, that's probably going to be more. I think, and the more that we get is probably going to be some direct aid to state and local governments. North Carolina is already expected to lose $2 billion of revenue into the general fund. The highway fund is being decimated. The Department of Transportation in North Carolina has already cut projects, I should say, that they had online for next year. So I do think we're probably going to get some help from the federal government for state and local governments, and they need that. Now, I've often been questioned, and probably Tom and Mark, same thing. Well, what are the downsides of this? What's the downside of all this borrowing? And of course, everything the federal government does on the fiscal side is borrowed money. Isn't that going to raise the debt? Yes, it is. Well, isn't that a bad thing? Well, the question here is if your economy is burning down, even though it is a mandated burn, it's a controlled burn, if you will, does it make sense to borrow against the future, borrow some resources against the future in order to save businesses and save households? I think it is, but anyway, that's, I think, the trade-off. Now, monetary policy, traditionally, the Federal Reserve has that ability to, in the old days, print money. Of course, it's all digital now. And the worry was if they did that, higher inflation. We don't see inflation out there now, and so I don't think that's an issue. Next slide, please. When's the recovery going to happen? The president's already eager to restart some of the economy. I think he's today I haven't watched TV today, but he's maybe already outlined some notions there, if not soon. We've had some protests, people saying, why are we shutting down things? I'm losing money, et cetera. This again is a question, and Tom spoke to this very well, balancing health and the economy. The cost of containing the virus has obviously been curtailing the economy. The benefit of curtailing the economy has been that we've saved lives. And obviously we have to balance those benefits and costs. Now, there was a nice paper done, and I highly recommend it to anyone. There's a nice paper done, oh, my slides disappeared. Nice paper done by the American Enterprise Institute recently that showed that the balancing of benefits and costs importantly depend on the infection rate. The lower the infection rate is, the quicker you can get the economy up and moving. And the data I have seen on the infection rate shows that it's fallen by about 2/3 over the last month to 6 weeks. So that's certainly good news. But again, that's what our decision makers are going to have to take into account. Next slide, please. What kind of recovery we're going to get? Well, economists have this odd thing of naming recoveries by the alphabet. We have the L, W, V, and U recovery. The L recovery is one where we really never recover. You fall into a recession, you never get out of it. Japan in the 90s was like that. We hope that everything the federal government's doing, we're going to avoid that. The W recovery is one where you double dip. You have a recession, you have a recovery, then you have another recession, followed by another recovery. We had that in the early 80s. What we're worried about here, I think, is if the virus comes back in the fall, which most of the experts say it will. If we've loosened up before then, will we have to tighten up and therefore maybe have another dip in the economy? So that's something to watch if that virus does reemerge. Everyone hopes for a V, where we get a quick bounce back. The president has talked about a quick bounce back. But I think the more likely answer is we're going to have a U, where we do gradually come back. But if you follow that and look at some of the forecasts, it's probably, I think I already said this, probably at least a year, if not longer, before we get back to any semblance of what we had. Now, in terms of North Carolina is going to follow this pattern. And one thing I'll say about North Carolina is I don't think our brand has been damaged by this. In fact, I gave a talk the other day to the North Carolina Economic Partnership. These are the folks that recruit businesses for the state. They've had no fall off of interest in coming to North Carolina. If I was in New York City, I probably would worry about my brand, but I don't think this is going to adversely affect North Carolina. I do want to highlight, though, two industries that I think are really struggling in North Carolina as well as in the nation. One is the tourist industry. I think it's going to take people a while to get back to traveling for fun. And of course, North Carolina has a multi-billion-dollar tourist industry. So I think we need to watch that. And then our agricultural industry. It's not that we're not producing food, but if you think about shutting down all the restaurants, we have an economy now where about 40% of food is purchased in restaurants, 60% is at homes. We've pretty much taken away that 40%. And farmers and agribusiness firms just can't flip a switch and take all of that product they sold to restaurants and sell it to people in grocery stores. There are different regulations, there are different packaging, et cetera, different things that people buy at the grocery store than they buy in restaurants. So that's an issue. And for example, today in Raleigh at the North Carolina Farmers Market, we saw the House of Rayford, a chicken producer, bring refrigerated tractor trailer trucks to the farmers market, and they're selling chicken at about 78 cents a pound. And they've had lines of cars all up and down I-440. So we do have an issue there with farmers. Fortunately, in the 2.2 trillion stimulus package or rescue package, there were tens of billions of dollars for farmers. But clearly, we want to keep our eyes on that. And I participated in a conference with the Commissioner of Agriculture and the Farm Bureau the other day, and they're well aware of this and communicating their concerns to the federal government. Next slide, and I'm wrapping up here. Next slide. So what are some of the potential changes in a post-virus world? Tom mentioned changes in restaurants, changes in businesses, et cetera. One I think that everyone's very interested in is now we have tele and everything. People are teleworking, they're teleschooling, they're telemedicaling, doctoring. Question is that going to continue? Or will people say, hey, I tried it, don't like it, I want to go back to the old way? My guess is we're going to see a takeoff in tele everything. So that has implications. I think globalization is going to be revisited. I think there are a lot of concerns, particularly about China and what's being revealed recently about maybe how the virus emanated in China. I think globalization is going to be revisited, rethought. Supply chains, Tom mentioned this, are going to be revisited. I think there's some opportunities, particularly for North Carolina, maybe to get in some new supply chains with respect to producing medical clothing, medical devices, medicines, farming, food, et cetera. And then the last one I'll mention, I find very intriguing. Dan Gerlach knows this very, very well because he worked in this area for years, both with Governor Easley and then at the center he headed, escaping me, Dan. I'm sorry. You're not there, so I don't follow as much.
The Golden Leaf Foundation. Shame on you for forgetting about tobacco.
No, I knew you were there. Just the name escaped me. We call it the Gerlach Foundation. Anyway, I think that people may be rethinking where they want to live. Right now, this century, in fact, the 21st century has been where cities have come back. Where I grew up in Cincinnati, inner city neighborhood, it was really rough. That's now where all the millennials want to live. We see that in Raleigh, we see that in Durham, we see that all around the state. I think there's going to be a thought by many that says, you know what? Yeah, there are all these benefits in big cities, but you know what? If you're there and we have another pandemic, much more greater likelihood you're going to get infected because you're there elbow to elbow with people. So I think people are going to start rethinking, some, not all. Maybe there's a benefit to living in a small town. Maybe there's a benefit to living in an area, especially if you can marry that up with telecommuting, using telemedicine, teleeducation, et cetera. So there may be an impact of this on the urban-rural divide. And I'm done. I'll be happy to participate in questions later. Thank you.
Well, thank you very much. Appreciate it, Mike, and always great to hear from you. We're going to pivot now to Mark Vintner. And Mark, of course, I've got the San Francisco background in honor of Wells Fargo and backing me now. So, Mark, I just from the business community and the banking industry perspective, want your take on this. Of course, you know, we sense at the chamber a kind of a restiveness in the business community about. We understand some of the things that Tom Barkin and Mike Walden talked about are necessary to reopen it, but interesting what you're hearing from the business community side, in addition to the questions that have been posed about what they can do and how eager they are to help fix this, you know, whether it be broad scale testing or things like this to get us back, because we've taken a lot of measures and probably some of them were more efficacious than others. So Mark, going to pivot to you, and thanks for being with us today.
Sure, and I have a lot of slides, but I'm gonna take Tom's advice and boost my productivity to get us started along here. So a lot of this has already been talked about, and it ought to match up very well because the slide deck will be made available to you, and you can go and look at some of these things. Go ahead and advance to the first page, which has got a quick little summary. And I noticed that we have the wrong words there next to North Carolina, but I can fix that later if need be. But in terms of quantifying the contraction, this is going to be a deeper recession than we went through in 2008, 2009. But it is going to be shorter, much shorter than that. And a big part of that is that we didn't have structural excesses that impacted the financial sector. And if the financial sector got bogged down, and there was some risk of that, and the Treasury and the Fed moved very quickly with some well-targeted policy moves that I think have really helped minimize the risk that, you know, high debt burdens, the number of companies that slip from investment grade to just below investment grade might have trouble rolling over debt. I think we've minimized a lot of those problems. That's one of the reasons why the financial markets have stabilized. And a lot of large businesses are now focusing on what it's going to take to get their businesses up and running. Not so much getting back to normal, but getting back to whatever the next level is that we're going to be. In terms of the shape of the recovery, when you look at some of the slides, particularly the slide that I have on North Carolina employment growth, it looks like a V-shaped recovery, but a lot of that has to do with the law of large numbers. And so when you have a big, sharp percentage point decline in economic activity, let's say we're employment, which is what I've got projected, that the percentage rebound off of that decline, it gives you a V shape. It gives you, in fact, kind of a J shape, but you need a much larger percentage gain to recover the jobs that were lost. And so it's a little misleading when you look at percentage changes. And I think that's one of the reasons that economists talk about V shape and W shape is they're looking at GDP growth rates. Most people don't look at their business that way. It's going to take us, by the end of 2021, we figure that we will have recovered a little over half of our losses from the recession, which will mostly be incurred in the current quarter. Most of the losses will be in the second quarter of this year. Things will continue to drip down a little bit in June, but we should be on the mend by then. But it's going to take all the way through the end of 2021. We're only going to recover about 60%, 55 to 60% of our losses. And by 2022, the end of 2022, that we will have recovered. Go ahead and flip to the next slide, which is just one of the ways that I found that early on, we were looking for mileposts as to how we could benchmark where we are in the cycle. And the best that I could find is if you look at the 12 countries in what I would call Western continental Europe. So we're not taking the UK in there, but basically Italy over to Portugal, up to Sweden. And if you take that collection of countries, there's 12 of them. They have a total population of 334 million people. They did not suspend travel to China, and as a result, the infection took off in Europe about 2 weeks prior to it did in the United States. And it's been a very good leading indicator as to where we were headed. The curve is flattened in all areas right now. And some European nations are beginning to talk about reopening. And I think we're going to see the same thing happen here in the US. I think that areas that have been less impacted and have less risk are probably going to start opening soon. Maybe some by the end of April, but certainly by May, by right at the first week of May. I think a bigger round of openings will occur around Memorial Day and around June 1st and around June 20th, the start of summer. I think all of those have some significant meaning to them, and that areas that can be easily socially distanced are going to come back online. But that's not a return to normal, but it will give us some big percentage increases, because if 85% of the restaurants are closed and the ones that aren't is take home and delivery, and you go to 60% of the restaurants being closed, that's a huge percentage increase. Go ahead and flip to the next slide. I'm going to flip through some of these slides pretty quick. Jobless claims, as has been mentioned, 20 million over the last 4 weeks. It does look like we're past our peak. Go ahead and flip to the next one. A good part of the job losses that we've seen have been in the leisure and hospitality sector, which has mostly been at restaurants. It's mostly been in the most labor-intensive parts of the restaurant industry, which is full-service dining. More limited service options, sort of the fast casual, which was the fastest growing part of the restaurant industry, that's held up relatively well. And fast food with drive-throughs is holding up holding up also. But my guess is that when we come out of this, there's going to be a greater push toward fast casual. Go ahead and flip to the next one. If you look at the makeup of services and goods consumption in the economy, what's really unique here is that some areas that were typically resilient to recessions have gotten hammered, most notably healthcare, but really even restaurant dining is an area that tends to slow in a recession that doesn't get clobbered like it did. Go ahead and flip to the next one. In terms of jobs that are able to be done at home, financial activities is the highest share of jobs that can be done at home, followed by professional business services and information, which is the bulk of the tech sector, which tells me that Raleigh and Charlotte are probably not going to get hit as hard percentage-wise as other areas of the state, even though the two will account for the bulk of job losses. The core industries that and we don't have government in there, which government, a lot of that can be done from home too. But in terms of where the impact has been, There's a lot more resiliency at Raleigh and Charlotte than there are in a lot of other areas just because of the composition of their economies. Go ahead and flip to the next one. In terms of the unemployment rate nationally, we're expecting the unemployment rate to top out at 15.5%. That's still a moving target right now, but I do think there's a very good chance that when we get the April numbers, that will already be at 12%. So I think it could get up that quick, that fast. Something that's very unusual is typically you can't just add up jobless claims to figure out what job losses are going to be, because some people get new jobs, but in this environment, not very many people are getting new jobs. So a job that is lost is likely to show up as a decline in employment and increase the unemployment rate. Go ahead and flip to the next one. Small business confidence has come down a great deal. And go ahead and flip to the next one. There's a special survey that was done by the NFIB, and it showed that a little bit over 50% of businesses said they had enough financial resources to continue to operate their businesses for 1 to 2 months. We are now through 1 month. It's a good thing that the payroll protection program has gone through. Not every company that's applied for it has been able to get funding as we've run out. And if you add in the number that say 3 to 4 months, it's about 75%. So we are going to need some help there. And if businesses fail, it's going to greatly extend the period of time that it's going to take for the U.S. economy to recover. Go ahead and flip to the next one. This is, and I think you can flip to these very quickly. This is open table dinner reservations. It shows you that the restaurant business is down 100% just about for seated dinners. Flip to the next one. These are some numbers that Tom talked about. Box office receipts down almost 100%. If you can find a drive-in movie, some of them are still operating, but I don't think the movies are very good. The number of people passing through the TSA is down about 90%. I shouldn't say the movies aren't any good. They just tend to be older. Go ahead and flip to the next one. Same categories. I guess the first one was employment. This is on spending. I'm going through too fast for my own good. Healthcare spending, 16.9% of the economy. If there's a surprise right now, I think it's in the number of doctors and dentist offices that have shut down. In my conversations with medical practices, kind of echoing on Michael's thoughts, they've all told me, not one of them has said that anything different than this. Telemedicine is here to stay. It's going to be a larger part of their business model going forward. And they do not expect to rehire anywhere near the workers that they let go. That's what I've heard to every one of them. When I look at some of the economic forecasts that are out there, they don't even have a decline in healthcare. So it's not just elective surgeries, it's all aspects. Now, I would think that dentist offices is something that dental is something that's not going to be able to done via telemedicine, but a lot of other things can be. And so I think that, it's not so much on the spending side, but on the employment side, that could be a more significant drag and more significant change that people are counting on. Go ahead and flip to the next one. I want to wrap this up so we have time for questions. Flip past this. You can flip past the population numbers, old news, flip past this one and get to North Carolina's economy was slowing before the recession hit. Job growth was only at 1.2% February to February. We were kind of suspecting that we were going to get a little bit of a catch-up number in March. So it'll be interesting to see what we get because the March national numbers were down really big. In terms of jobless claims since March, since the last 4 weeks, we've had 540,000 jobless claims in North Carolina. Pretty substantial increase. About 40% of that has been in leisure and hospitality. Another big chunk has been in retailing, and another big chunk has been in medical care and in other services, which are mainly household and business services. Go ahead and flip to the last slide here. This is our projection of job growth, and it shows you the V-shaped or the checkmark shape. We're estimating that we're going to lose a total of about 480,000 jobs total during the recession, and that we are going to gain back about 56% of those by the end of 2021. So even though the percentage gains are higher than where we were previously, we don't recapture all of those losses. Go ahead and flip to the last. I guess there is one last slide on here, which is our forecast table going out forward. looking for a 22% drop in GDP during the second quarter. I've seen estimates as high as a 60% drop. I think that guy must be from Colorado, but I do think that there's a wide range out there in terms of how much activity could fall, because there's so many parts of the economy that don't usually get hit in a recession that are likely to get hit pretty hard in this one. So let me stop there and we can move to Q&A.
Great, thank you very much,
Hi, Dan.
Dr. Mark, for that. We're going to turn it over to Janelle Boyd, who's looking at some questions.
Yes, I am. Okay, so the first question that had the most votes is, do you have any insight on when and how the North Carolina stay-at-home order will be lifted?
This is Dan, I'll take a shot at that first, take one for the team here. Governor Cooper talked about yesterday about the idea of tracing, testing, and trends as his focal point. So we talked a little bit, you saw on Mark's slide about the logarithmic scale of cases, and so that's tending in a positive direction. I think right now we at the Chamber and others are trying to get the private sector to be of use, what use we can be to the governor and to his team about how do we increase testing. I mean, they said, well, we need that, so let's get it, let's deploy it, let's use all the resources we have here in a very biotechnology rich state to help with that, and tracing as well. So that's the type of thing. And two, it's going to have to be, as Mark indicated, that behind restaurants and accommodations, the biggest job loss in March was in ambulatory health services. And those are high wage jobs. I mean, restaurants and accommodations, not the highest wage jobs, but those ambulatory health services, very high wage. And I think what's going to happen is they're going to be eager to figure out, well, we're burning through some of our money, our loans, or how much of that we're going to take on. Take some creative ways to help convince government that they're ready to open again.
And this is Mike Weldon. Let me just add that the General Assembly, I believe, Dan, correct me if I'm wrong, comes back at the end of this month. President Pro Temp of the Senate, Phil Berger, has already sent signals. He's anxious to see the economy opened up. So there's probably going to be some back and forth, probably not surprising, between the governor's office and the governor's people, and particularly Berger's office and him, in terms of how fast this will happen.
Thank you. Okay, the next question is, PPP is out of money. Odds of 250 billion more.
It's out of money, and there are proposals to Mitch McConnell, majority leader in the Senate, tried to have a simple voice vote on that a week ago, I think, shot down. I think both parties are interested in seeing that fund replenished. There's some pushback. I think you probably all heard about maybe changing some of the provisions, particularly the requirement that 75% goes to payroll in order to have that loan turned into a grant. I think the Republicans up here want just the simple, change the number, and the Democrats want to change the number, but they want to add some other things too. So we'll see how that goes back and forth. Apparently, both houses are not coming back, however, until early May. So I think there's probably going to be pushback and pressure for something to be done before then, because you're right, this is out of money, and a lot of businesses are relying on this.
Okay, thank you. The next question is, how much decline do you expect on residential, single family, and multifamily combined construction spending?
This is Mark, I'll take that. In terms of residential, we started out this year really strong, and I would, single family home building, single family homes have been underbuilt across the state and across the country. So we don't have an oversupply of single family homes, but we've seen a big drop in buyer traffic with all the stay-at-home orders, and it's right during the spring selling season, which accounts for a disproportionate share of sales. We've also seen some contract cancellations. It's not been a huge problem. It's not like what we saw in 2008, 2009. But that's going to take some of the wind out of the sails that we started this year. But because we started off so strong and we're so much above where we were in 2019, we're looking at single family home buildings probably only going to end the year down 7 or 8% from where we were last year. And most of that decline will occur in spring and early summer, and we'll be improving in midsummer through the rest of the year. So we're looking okay there. In terms of apartment construction, there's a lot of work underway right now, and the apartment market was outperforming expectations for a very long time. I don't think we're going to see a move away from the cities. I don't think not cities the size of like in Raleigh or Charlotte. I think that those cities are preferred. They're going to be increasingly preferred as opposed to mega global gateway cities. New York is a global gateway city, and I think that the mega global gateway cities are also gateways to a lot of the undesirable impacts from globalization, one of which is they're more susceptible to viruses. In Seattle and New York, two big global gateway cities, you could throw San Francisco in there too, are early virus hotspots. But they're also, those globally connected cities tend to be having greater trouble with income inequality because they're magnets for foreign direct investment, which has pushed up the value of housing. They have a disproportionate share of very high-end retailing that focuses entirely on foreign buyers and is kind of shuts out, and it kind of feeds the inequality issues. I think that that's where you're going to see a backlash. I think it actually plays in a little bit to Charlotte and Raleigh, but we're going to have an overbuild of apartments because we've got peak levels of deliveries. Nationally, there's nearly 2 times as many apartments under construction today as there were completed in the last 3 months. So it's, so we've got, well, it's on the average of the annual rates, but there's like 600,000 and something under construction. Completions have been running around 300,000. So, we've got a whole lot of supply coming in at a time that not only are some folks having trouble paying their rent, but job growth is going to be slower on a net basis. We're not going to recover all the jobs that we lost for a couple of years, or 18 months at least, and that's going to make absorption very, very slow.
This is Tom. I just add, I agree with Mark on the fundamental health of the residential sector. I'll say though, in this environment, where you're not comfortable necessarily having someone come into your house, there's a core part of the sales process of particularly, owned real estate that it's going to have to go through a transition. Until such time as you're comfortable with someone looking at your house, it's just going to be pretty hard to get those under contract. So I do see some dip until we get to the other side.
Yeah, the numbers I was referring to there was, I guess I was on the new home construction side,
yeah.
which don't face that issue. And so I think that housing starts probably won't see as large of a dip, but the existing market, in terms of its contribution to GDP, it has really grown because the new home market has been smaller, and the realtors' commissions are a big part of that. It also tends to drive spending at home improvement centers and in home furnishings, and so it's a real key driver for the economy. The longer that's off track, the longer it will take for us to recover.
Thank you. The next question is, coming out of the coronavirus crisis, what industries will be the winners, and where should North Carolinians concentrate on recruitment?
Well, one thing I mentioned in my talk, this is Mike Walden, is that if we do have renewed interest in developing or reinforcing domestic supply chains, North Carolina should look toward that. And I'm speaking with our business recruiters, they're already thinking ahead to that in that regard. Potentially new manufacturing supply chains, medicine supply chains, food supply chains, et cetera. So that's something I think that we are well positioned in some areas to pursue. And it depends on what the reaction to globalization is after and when we do get on the other side. If it's strong, that may actually boost some business recruitment and development opportunities for North Carolina.
Yeah, I would just add on that, Michael. I mean, when every recession that we go through, Trends that were on the downswing tend to be amplified as capital dries up almost completely for them. And trends that were ascending tend to see more capital thrown at them and they ascend faster. So on the downside, I really think that some old line brick and mortar retailing, the major full service department stores, and certainly not all of them, some are doing a better job than others, but I think there's going to be a big enough shakeout that the consolidation among major enclosed shopping malls is going to accelerate. And we were looking for about 3/4 of the malls that are currently in operation to be dismantled and repositioned over the next 10 years. That's probably going to happen a much quicker because as these large anchors declare bankruptcy, that's going to trigger covenants in the leases of some of the other stores where they're going to be able to walk. And so we're probably, that's something that I think is a big issue in the very near term. On the plus side, of course, the supply chains, we wrote a paper a couple of years ago talking about what was going right in manufacturing, and the labor content to produce just about anything has dwindled, while the political risk, the risk from climate change, and the risk from pandemics, which we've had a number of. This is the first one that's impacted us since China's gotten into the WTO. They all now outweigh the potential savings from labor costs. We've been seeing a big reshoring. I would expect that to accelerate. And then certainly all the technologies that are going in and allowing us to work remotely, I think are going to do very well. And I guess the last one I would say is this push away from full service dining and really somewhat from fast food to fast casual. Chipotle is a fast casual example, as Panera Bread is, and there's lots of other ones. I think that accelerates as well.
I would just add, and I hope and expect that in the context of this public health emergency, our hospitals, including rural hospitals, our doctors, our med schools, and nursing schools, and certainly public health supplies and manufacture would be other great places to be.
Right, I could add some color to that the EDPNC, the Economic Development Partnership in North Carolina, business is still brisk. I mean, businesses may not be ready to commit right now to capital spending and turn dirt, but certainly there is no downturn in interest in the Charlotte and Raleigh markets right now. Second thing is there'll be interest in consolidation. This will force efficiencies as businesses look, say, okay, how do we do things more nimbly and consolidate some of their operations in North Carolina, if it keeps its competitive business climate, both in reality and reputationally, which North Carolina Chamber has helped do, is then it will attract those consolidations because there may be one litter, maybe not all together. There's a question down the line about tourism. I think that in North Carolina, clearly the cases per 10,000 and the deaths per 100,000 are well below the national averages. And in our rural areas, we haven't seen that praise. So I think for the tourism economies is to say is, yes, we're up when we are ready to open that this was not as big an issue here. We do not have that kind of everybody's on the subway, that kind of spread that unfortunately the more crowded areas that get a lot of tourism do as well.
Thank you. Thank you all for attending today's presentation on Ask the Experts, the COVID-19 economy, slowdown or shutdown. We hope you found today's content valuable. You will receive a brief survey of the webinar via email. We would appreciate any feedback you can provide to allow us to improve these sessions. Again, the recording of today's webinar will be made available to you via email within 24 hours of the webinar. Thank you and stay safe and healthy during this time. Thank you all. Thank you, Mark, Tom, Dan, and Mike. Have a great day, everyone.